Go. Hi everyone, my name's Danielle Ecuyer. I am the author of Shareplicity, a simple approach to share investing. I've been involved in share investing for over 4 decades, both professionally and personally. I manage my own portfolios, and last year I published my first book. Today, I'm really excited to have with us Steve Palise, who is basically a property specialist. And Steve has also published a book on property investing. And today we want to discuss the difference between property investing versus share investing. Since I really don't know that much about property investing, I've always been an owner-occupier, and Steve probably doesn't know a lot about shares. So Steve and I have one thing in common. We both have the same publisher, and that's how we met, through Major Street Publishing. So Steve, welcome. Fantastic to chat.
Awesome. Thanks for having me, Danielle. This should be fun. So, yep, I'm also a publisher. I just released a book called Commercial Property Investing, Explained Simply. It's the first commercial investing book on the market, just mainly because it's a really unknown space. But I purchase all types of properties, so residential, commercial. I've got about 800 property acquisitions to my name now, so know quite a lot about property, but like you said, almost nothing about shares. So this should be a fun chat about the differences between them.
Fantastic. Well, I wanted to touch on interest rates, and this is the first thing that actually Steve and I discovered before we started the podcast, where there's a huge difference between the way the asset classes actually react in the short term with interest rates. So I just wanted to give a view to the viewers about how I see interest rates, because they're obviously at a historically low levels at the moment. And there's quite a lot of concern in the share markets that interest rates are going to go up because inflation is going up. And you've seen that overnight in the US, where you've actually had quite a strong inflation year-on-year reading, up around 4.6%. So I just want to put it out there to the viewers. I'm not an economist, but I do read a lot of people. And I think from a share investing perspective, there are 2 major schools of thoughts, and it's diametrically opposed. Some people are saying interest rates will not go back to historic levels, Steve. They're basically saying we're not going to see interest rates anywhere near the levels that you saw, not even, probably 6-7%, let alone the 14% that we saw in the late 70s, early 80s, when the Fed chairman Volcker was trying to squash inflation out of the system. So there's the school of thought that interest rates aren't going to go dramatically higher because there's a lot of deflation in the system, and the deflation is kind of secular deflation through the likes of aging demographics, disruption through robotics, through e-commerce, through digitalization. And then there's another school of thought where they say interest rates are going higher. And obviously for shares, this has an impact on how you value them. But chatting to you beforehand, it's quite interesting because you have a slightly different take on how you use or value or use interest rates when it comes to buying property.
Yeah, exactly. So I'm a little bit different. So it does affect obviously property in terms of people going a little bit crazy and saying, I'm going to purchase an owner-occupier because interest rates are low. But I'm an investor and I work with investors. So I'll always treat it over the long term. Like every property I buy, it's not a buy, reno, flip. It's a 15, 20 year kind of hold. So I'll always base it off worst case scenario. And I used to be a structural engineer, so I'm always risk adverse. I'll look at it generally. I'll make sure I can handle my portfolio at 5-6% interest rates, because that's a general high end of the average, and then go from there. What they actually do in the short term changes by sentiment a little bit, but for me, it shouldn't change the investment fundamentals. You need to be buying with a 15, 20 year mindset, because if you're buying now for the sake of interest rates changing 1 or 2%, property is probably not the right thing for me, but you can argue otherwise. I think shares is a better option if you're trying to play that short game.
Yeah. So when you're advising a client, you are basically saying, even though you could get, I don't know what an investor mortgage is at the moment, what rate are we looking at?
They're really low at the moment. They're sub 2% for residential. For commercial, I'm seeing about 2.5 to 3.5%. And then the returns in terms of yields, residential, you're generally getting about a 4 to 5.5% gross yield. And then commercial, very varied depending on what commercial you buy, but generally 4 to 8% net return. So quite
return after costs.
And that, So yes, right. So with commercial, the tenants pay the outgoings. So the only actual kind of outgoing that you theoretically have is whatever mortgage you have on the property. If you don't have a mortgage, obviously they take that out. But residential, you've got things like council rates, water rates, building insurance, landlord insurance, maintenance, things like that. So that's why it's a gross yield. So after you take those out, they're generally down at the 2-3%. But people that buy residential are banking on capital growth. So they're not looking at the cash return. They're looking at, they're happy to buy it even if it's negatively geared. So it's costing them money, but they want it to double every 10 years, for instance. Whereas commercial, a little bit different. People are buying for the cash return. So you can actually work out your ROI, but then capital growth is a bonus. So there's a big mix. Like you could buy a residential property that's a dentist. So that's sort of residential, sort of commercial. And then you've got the other asset classes as well. So general ones are industrial, retail, and office space. They all happen in different cycles, different growth factors, different cash flows. So with commercial, it's going to come down to the property itself.
Right. So it seems to me that obviously when you're doing the calculations for the clients, you're assuming that they are going to have their cash flows are going to have to cover potentially a much higher cost of funding mortgage. So you do a worst case scenario to just, I suppose, ring fence and make sure that this investment will generate enough cash flow that can cover the debt servicing payments should interest rates, mortgage rates move up to that 5-6%. Have I interpreted that correctly?
Yeah, yes and no. So for residential, I want to just make sure that financially they can handle the repayments should interest rates go up. So they might be buying, say, a property that costs you $5,000 a year to hold. If it goes to, say, $15,000 a year to hold because interest rates go higher, they need to be able to financially handle that. And so everyone's different. Obviously, if I've got 10 properties and each of them are $5,000 negative, and then that happens, that could be a bad scenario. If you've got the one, it might be easier. So it's going to be person dependent, but I always do worst case scenario. So you look at, can I handle and weather the storm? Because property's been a reliable performer. Like every capital city in Australia has quadrupled in value in the last 30 years, quadrupled. So if you have a long-term mindset and we see that same, I'm not saying it's going to happen, but if we see that same kind of process happen, long term, you're going to be all right. So you just need to be able to weather the storms. And we can have a chat about risks and all things like that. But I obviously like property because it's a physical asset and it's tangible and it's necessary for life.
Yeah, it's interesting because you've really touched
on. So what do you find?
Sorry, go on.
I was going to say, what do you find with shares? Do you find people are worried about interest rates, or they not even kind of? Well, it depends. I'll get you explained, but it depends on what type of share, I imagine, as well.
Yeah, so it's sort of similar, but the one thing that I kind of wanted to draw out, because it's really important that you touched on the point that like property has been a winner for the last 30 years. So I'm a bit older than you, Steve, so I can go back to a time when my mother goes, oh my gosh, you do not want to own and invest in property, because about in 2013, I decided that I wanted to kind of diversify my self-managed super fund a little bit, just out of a concentration in shares. And we looked at putting like a little syndicate together to buy an investment property. And it's a shame I didn't get anyone over the line, because there's actually a new building, a good quality one out in Liverpool. And I think we would have absolutely made a killing, but people were very nervous, etc., etc. But interestingly enough, because my mother had such a fear, because she remembers interest rates at 14, I think even mortgage rates got up to 17%. Yeah. And my stepfather, who sadly has since passed away, but he was a real post-war baby. And what people don't realize, so this is what I always talk about, is that post-war, nobody actually wanted to own property. And I'm talking about the UK. This was in London. And the really interesting thing is that we've had the most incredibly favorable demographics, okay, growth in population, immigration in Australia, plus interest rates going down, 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 down for the last 35 years. So the first property I bought, owner occupier, was 1987, after the stock market crash. And I have been a big proponent of actually saving through my home. So I'd gear it up to the nines and then I'd pay it off as I got a bonus out of shares. But both asset classes, where I'm going with this is that both asset classes, shares and property, have been massive beneficiaries of these interest rates coming down over time. And I guess the question mark in Australia is, you have to ask is, Australia's been a beneficiary of really good immigration levels that have basically been driving, gross GDP, not GDP per person so much. So I guess just short term, it doesn't seem to me that, like investors, because I see that investing for property through the bank lending is actually going back up again. So obviously investors in Australia are taking the view, wow, prices, particularly in some of the residential high-rise stuff, got really knocked around in the GFC. But they seem to be possibly coming back in, and a lot of investing coming back into the property market at the moment, taking a long-term view that we will move into the post-COVID world and immigration will start to pick up again to get that uplift. Is that kind of how you're seeing it?
Yeah, but there's a bit more to it than that, because property is based on demand. So it's supply and demand, how much people are willing to pay for it. So one of the big drivers I always look at is affordability. So can someone physically afford where they're buying? And for me, one thing people don't talk about with property is 20 years ago, most households were one household income. Now, I actually don't have many friends where they've got actually stay-at-home partner. They're both two income. So all of a sudden, you've got double household income. And I think that was a big driver for the last growth spurt of Sydney and Melbourne, just because people could afford twice as much. They went from $1 million budget to $1.8 million budget, and that pushed up as well. That can't keep happening, obviously. So that's at the glass kind of ceiling. But different areas of Australia, people that live in Sydney or Melbourne have very closed-minded. They've got their blinkers on and they think, properties aren't affordable. And it generally is in Sydney and Melbourne. It's about 10 times the average household income. Somewhere like Brisbane, for instance, you're buying at more than half the price of Sydney, and it's only about 5 times the average household income. So you're going to have movements there with like people moving. And like you said, once they open up the borders, those areas were probably going to be the ones that grow actually more, because unless the people coming over with lots of money, they're going to move to affordable areas. So supply and demand plus household incomes. But like you said, interest rates are going as well. But there's way more to it than, like, you need rising incomes. You obviously need people wanting to live there, infrastructure spending. The type of assets obviously huge as well. So you touched on buying like a high density apartment. Just personally, I actually hate high density apartments. I don't like the idea that I own a piece of concrete in the sky. So I don't physically actually own anything, any land component. And you're at the helm of oversupply for something like a high density apartment, because if they buy 10 houses next to you and build a 20-story high density apartment block, all of a sudden you've got 1,200 properties on the market at the same time. So then you lose your rental increases and you can have high vacancies and things like that. Whereas if you're sticking with houses, you can get some good fundamentals with the numbers in vacancy rates and things like that. So it's much like shares. It's going to depend so much on what you're buying, where you're buying, why you're buying. As I mentioned before, what I love about property is people need it. It's actually a necessity for life. So if you've got something there, we can argue all day whether it's going to go up or go down in the next 20 years. And that's the thing with property. But historically, it's been a strong performer, even through the high interest rates. So I would have hated to have lived through 15% interest rates, but anyone who actually physically survived that period and had a few properties reaped the benefits. Like I remember in 2012, when I bought my first property, I bought a house in Western Sydney for $230,000. And people at the time were actually laughing at me saying, you think it's in Western Sydney, it wasn't a great house in a great suburb. They were laughing at me saying, how is that ever going to go up in value? That same house now is about 700, 800, and they're saying the same thing. So there's always going to be a perception, but big thing for me is affordability. If people can't afford it and there's no work there, it's not going to have demand.
Fair enough. Fair enough. Yeah. Well, shares are kind of different because they're obviously, I mean, it's so much at the opposite end of the spectrum, isn't it? Because you need a decent deposit for a property, whereas a share, you can basically spend $500 and you can go out there and, you can buy a share, or you can buy what's called an ETF, which is basically an exchange traded fund. And that's like a bundle of shares. So it's like getting a bundle together. So it's a completely different proposition for people in terms of how to grow your wealth. And like property, shares have been a great long-term performer. I know that the latest stats that I actually had in the book, I think the total return on the Australian Stock Exchange, the ASX, the All Ords have been around, it was as high as 11.6% up until 2019. So it's actually been that's a total return. So that's your capital gain as well as your dividend income. And like property, my, kind of brief understanding of it is that you have the same components. You have a share price that moves up or down. So you can generate a capital gain or a capital loss only when you actually sell the shares, but also that you can have shares that pay dividends, which is like a rental income or a commercial income on a property. And like property, I mean, there's a spectrum of shares where it varies so greatly from those shares that don't pay dividends and they're meant to deliver very high capital gains to investors, and those other shares which have typically not grown, had so much capital gain but had a higher dividend income. So it seems to me that the similarities kind of in the asset classes is that you just, it's quite hard just to generalize. You really have to know, if it's property, you have to know what your investor wants to do and what their affordability, funding capabilities are, etc., and then seek out the best properties. And shares are a little bit the same, because people really need to know, because shares, you can see the changing price of a share every day, whereas a property, you don't see that. That's the thing that I think people find really hard. Is that they look at their shares and they say, oh my gosh, they're going down in value, but they only go down in value if you actually sell the share. Up until that point, everything's either a paper profit or a paper loss. But that volatility in seeing things go up and down is what actually freaks out investors most of the time.
Yeah, you can also get in and out of shares a lot quicker as well. Property, not so easy, because you are leveraging, and a lot of the times you're putting quite a lot of money just to purchase the asset class in terms of stamp duty, purchasing costs, selling costs are quite a lot as well, because you pay 2% to a real estate agent. So,
yeah.
And just time on market as well. Like Sydney at the moment, yes, it's very hot. You can sell quite quickly, but prior to that, you're sometimes 30 days to 120 days is average time for you to offload the stock, whereas shares gives you that versatility, which I obviously like, but property obviously gets the leveraging side of it as well. So just to your stat about the 11%. So on average, every capital city in Australia for the last 30 years has grown between 5.2 and 6.2%. So that doesn't sound as impressive as shares.
Is that the capital gain, Steve, or is that the total return?
No, so the capital growth. So that's not taking into account. That's not taking into account any rental income that you received.
Yeah.
But then obviously the power of property is leveraging. You can buy properties on 90% loans, and back in the past 95% loans. So you can reap the benefit of that, but you can also have the opposite. If the market goes down, you're basically leveraging your losses as well.
Yeah, well, leverage is a really good point. So you've raised two really good points there. Shares are obviously much easier to buy and sell. And you literally, you put your order on, it goes straight through. And assuming the whole trading system, the platform doesn't go down, which occasionally it does. I actually noticed, because, talking of another asset class, crypto, well, obviously there's been this little bit of a crash going on because of Elon Musk.
I was gonna ask you what your thoughts on crypto were. I was unsure if you were going to be positive or negative.
Well, no, I just want to make the point that people always forget that sometimes if you have a crash, right, the trading platforms that facilitate the trading sometimes go down as well, because they can't handle the volumes. I've seen it happen once, maybe twice with CommSec, when you've had a couple of big shakeouts in the market. And I noticed today, because I always try and keep up with I don't know, everybody else and have a go at everything. It's part of my stay young strategy. And so I got a digital wallet and I went on and I'm on this platform, Gemini, and I bought some Ethereum a while back, some Ether. And I noticed today after Elon Musk goes, no, you're not going to be able to buy the Tesla with your Bitcoin. And I was kind of going away on my phone. Oh God, that's really interesting. Oh, okay. Gemini's down. Obviously, everyone's panicking and trying to sell their crypto all at once or buy it all at once. But basically, you know, on balance, you can buy and sell your shares. The share market is open in Australia from 10 to 4 p.m. Normally, there's absolutely no problems in terms of liquidity. It's quite simple, you know, that you have a number of sellers, you have a number of buyers, and they match up at the prices that they actually want. And the transaction, depending upon if you're prepared to take the seller's price or you're prepared to take the buyer's price, you can transact straight away. And as you said, it's much smaller amounts of money. It can be extremely large amounts of money, but you have that ease of liquidity, which is one thing that in my career, since I haven't really had a proper job since, you know, I retired before I had my son, I wanted to invest in shares because I didn't want to have everything in property because I own my own house. So that's a very personal preference for me in terms of, you know, how I invest. But when it comes to leverage, that's a really interesting thing with shares, because I know a lot of guys use margin loans. They use leverage for shares. Personally, I won't go there. It's just it's a risk too far for me. And even if I was, I think it's probably for if you're younger and you've got a high earning stream and you're not basically relying on shares, because to me it's far more speculative if you leverage on shares. So it's completely different, because if the share market absolutely crashes, you have what's called a margin call, and you suddenly have to come up with more capital than you originally put down to justify holding the shares. Otherwise, you have to sell the shares at a loss. And I always remember in 2006, I was kind of doing some part-time work for one of the guys that trained me as a research analyst years ago, and he was managing share portfolios for people. And I said, oh my God, what's going on there? And he goes, oh, we're just doing margin loans for the clients. And I'm like, seriously? Because a lot of them were kind of older clients, whatever. And I said, why on earth are they doing that? Oh, well, it's fine because the dividend income from the shares was high enough to cover the servicing costs of the margin loans. And I, of course, went, yeah, but you know, what happens when the market crashes? Oh, don't worry, it'll be fine. Well, I hate to say it, and it's not denigrating this particular person at all, because he's incredibly good at his job, but we had the early 2008 and ongoing 2008 GFC, where stock markets fell 50%. And I still meet people today that lost all their money in shares at that point in time. So whilst this is not, everybody that's watching, this is not, you know, advice. I am not a registered advisor, but I always say it's a lot more risky in shares to go, you know, borrowing to buy the shares. So it's not something that I would ever contemplate. I would prefer to just say, well, if you want to be racy, you want to buy something that's more risky, you can go and buy a crypto, or you can go and buy, you know, a Tesla share or something like that. You don't need to borrow to buy those asset classes, because whilst you potentially might make a lot of money, you can also get wiped out. And that's just not what works for me personally. But as you know, Steve, property is a completely different proposition, because you're sitting on a physical asset.
It is, but fundamentally the same concept applies. You can still lose quite a lot of money, yes. And it's all to do with their asset selection. So like if I was to go out and buy, say, I don't know, a residential property in a mining town, and I'm leveraged up 90%, and it's all great because you get a high yield there and your cash return looks nice and people think, oh, this is great, it's growing 30%. Some of those mining towns, when the mine closes, they drop 80%.
Yeah.
So if you've gone out and spent $1 million and it drops 80%, you've left with 200 grand. That's $800,000 you need to kind of match up with. So as with any financial decision, you need to obviously assess the risks with it. And I'm sure those that leveraging in shares, there's probably some lower risk ones you can choose as well. So you don't have to necessarily go out in big ones, but yeah, it's why it's called investing. There's no guarantees. If there was guarantees, everyone would be wealthy. That's simple.
Absolutely, absolutely. And
Yeah.
and that point that you just touched on is also really important, where there's kind of I suppose if we're doing a contrast and compare between shares and property, this is a similarity, a comparison, which is we have what we call value traps with shares. And it's often shares that seem really cheap and they have a really high yield, interest income, or not interest income, dividend income. And a lot of those shares can basically result in severe capital erosion. And that's what a lot of investors unfortunately found with the bank shares in Australia. They peaked in 2015 and then they literally just kept on declining. The banks were, a lot of Australian companies are very beholden to their shareholders and paying out big dividends. And again, I'm not an expert, but the whole franking credit thing that we have here in Australia, where if you pay tax or even if you own them in your self-managed super fund, you get this lovely credit back from the government because the company has paid tax. And that has meant that a lot of companies now, rather than investing for the future here in Australia, they've become very beholden to actually paying out high dividend payments to shareholders. But often, because the businesses haven't been spending for the future, haven't been investing for the future, like a lot of the big US tech companies, they spend so much investing for the future. It means that when all this disruption and technological innovation comes along, like let's say the e-commerce, digitalization, right? They're suddenly finding like, oh, okay, we've been hit out of the blue on this one. And I think it's really important that investors, whether they're looking at property or whether they're looking at shares, this whole concept of a value trap it applies to both of them, and they really need to have their eyes wide open. Like, if it sounds too good to be true, it kind of is a bit too good to be true.
Yep. And as you said, it's like, you got to have that long-term mindset. So commercial is exactly like that. You're not only just buying a physical property, you're also somewhat buying the type of asset that you're going into. So for instance, like petrol stations, you can go out and buy petrol stations, going to get a really good cash return. Can you guarantee that those petrol stations are going to be there in 20 years time? Probably not. And then COVID's obviously changed the shape of commercial as well in terms of offices and things like that. So different asset classes are going to have different longevities. One of the asset classes I really like is industrial, because no matter what happens, you're going to need physical space, because the world keeps turning. You still need car mechanics, spray painters, wholesalers, distributors, fabricators, storage. There's a versatile asset that you'll always need that space for. But something like a high density office, much like the high density apartments we were speaking about before, for me, there's no value there, because you actually don't own anything but airspace. And then different industries are going to act differently as well. So commercial is a completely different game to residential, because there's just way too many moving parts. It's the type of asset, the land component, how the economy's doing, where you think it's going to be in 15, 20 years time, how much value add you can do to it. And then even the business, you're somewhat investing in the business that's renting and giving you a return as well.
Yeah, now that's really interesting. I want to go back to when you mentioned petrol stations, because as you probably know, in the share market, we have exposure that we can buy property companies, real estate investment trusts, etc. And I seem to be always at the front end of the curve when it comes to progressive investing. And I actually don't own Waypoint anymore. They own a whole lot of petrol stations, really high dividend yield. It was 5 or 6%, but I have some real question marks over the longevity of how petrol stations are going to transition themselves in a low carbon world. And I do know a lot of people have been putting a lot of money in there. Can you just expand a little bit more, Steve, on how you view things? Do you see that petrol stations are going to have to transition to electric vehicle charging stations with a whole lot of other ancillary services? Let's say they have to stop for half an hour or something.
Yep. So that's exactly the way it's going. So most countries there's government incentives to be, I think by 2030 to be 80% electric vehicles. So petrol stations, for me, this is just my opinion, are a thing of the past. They're not going to be there in 30, 40 years time. And the electric charging stations won't be at that type of petrol station. Like there's no benefit to them going to a petrol station and parking their car on an empty petrol tank to fill up at a charging station. So that premise is redundant. Including that, there's actually environmental impacts for petrol stations
I
as well.
know.
So
Remediation is huge, isn't it?
Remediation, not even just in terms of cost, in terms of time. Like sometimes it's 3 to 5 years for you to get it to remediate. So for me, it's just way too risky. There's much better industries. You're right though, people are getting sucked into the high returns. You can get kind of 10% net yields on the property investment, and people are loving that. Great for the next 3 years. Probably not great when the property is worth half as much in 10 years time and you've lost all that cash flow anyway. The other one I always get sent by clients, and they say, oh, I found this, it's really high yield, I want to buy it, is banks. They love banks. And for me, I've not walked into a bank in 5 years.
Are you talking like a retail branch?
A retail branch, or like even in regional towns where they're freestanding building, and people are going out and buying those. And I'm like, you're effectively just buying an empty building with a nice little return for 2 or 3 years. Most indicators are showing they're going to be about 1/5 the floor space in 3 years time.
Yeah.
So again, it's like shares. You can go out and you can buy some high spec stuff and high risk properties. It's the same thing. You got to look long term, as I said at the start of the call.
Yeah, it's really interesting because I've got a new book coming out. It's called Shareplicity 2, a guide to investing in US stock markets. And it's a really good platform to discuss what I call megatrends, long-term secular changes that's going on in our economies. And what's really interesting is that those changes are also happening, as you've just touched on, in the property space. So there's a big section on transitioning to zero emission economies. We all know the Tesla story, etc., clean energy. There is also that whole thing about the digital wallet. Like you walk around now and you have your bank account with your phone, and China is so far ahead of the curve on this compared to even the US. And lots of companies like Square and PayPal and these fintechs are really acquiring so many new customers. Square, you all probably in Australia, you know, the little white square and you tap on it.
Yep.
But, you know, they've got their cash apps and everything like that. Now they have as many customers as JP Morgan. It took JP Morgan 100 years to get that amount. They kind of do it overnight because it's your generation and my son's generation who are like, don't want to be a dinosaur here. And so I think it's really interesting that, like, when it comes to shares, the same secular trends are probably playing out in property. And we've touched on banks, we've touched on petrol stations. I'd really like to just ask you, because I don't have any exposure to in the share market. So I own a lot of Goodman Group, which, as you know, is big into industrial. I'd be interested in your view. So do you think that COVID effect means that we're not going to go back to working in an office as we knew it, or is it going to be a hybrid model? How do you see it playing out, Steve?
Yeah, I'll quickly touch on a point before that. So
sure.
When you're buying property, especially commercial, with shares, you obviously can buy into some really big companies. And then with property, people go off some stats. Like the biggest one I hear is retail spending's down. Don't buy a retail commercial property. It's this high risk. Every single mum and dad investor, they're not going out and buying a Westfield shopping center. Like it's just out of their reach. So different, you're buying a little cafe or a little clothes shop or medical center or something like that. That's completely different kind of asset in terms of buying like a Westfields, which you might with shares. So looking at those big grand stats doesn't actually necessarily mean you can buy a bad one. You can buy a really good, like a medical center in a regional town, which is effectively a retail property, could be a really good investment. And it's got nothing to do with retail spending down. So you're buying it in isolation, which is completely different to buying shares with big spreads. So it also means that it comes with risks. All your eggs in that one basket. So you need to look at that property in itself. And different asset classes are going to perform differently in different locations, even in different sizes of ones. So like if you go out and buy a large industrial warehouse, that is a completely different asset to a really small little, different demands, different rate increases, different capital growth and things like that. So it's actually a lot harder to have a broad spread
Yeah.
and basic ability to actually you can buy the specific ones of course, but you can actually diversify in terms of a pretty large location.
Yeah, absolutely. Well, I'm just thinking, what haven't we touched on? Because we've gone through quite a lot of things.
So in terms of COVID, do you want me to maybe have a quick kind of update on COVID, how that's affected the market?
Absolutely.
Okay, so as I've kind of said, it's going to depend on what you bought, where you bought, but as a general rule, office is obviously the hardest hit one. So CBDs, most people now are only generally going in the office 2-3 days a week. So that's generally a 20 to 40% reduction. And people won't go back. I think people quite like having not 5 days a week, but 4 or 3 or 2. So there's that versus this. So there's really high vacancy rates in CBDs around Australia. So those asset classes are always struggling. Just my personal opinion, I never liked office locations in CBDs anyway. Again, no land component. You're just buying a bit of kind of concrete in the sky. So that's struggling there. Whereas a lot of big businesses are actually going to what's called the hub and spoke model. So they're reducing their floor spaces in CBDs by about 50%. But then opening little satellite offices around the point, it actually widens their pool in terms of skilled workers as well, because say you're in Sydney, you don't just have to rely on people within an hour's drive of the CBD or train. You can now start looking, say, Wollongong, Central Coast, even like a Coffs Harbour, by opening up little satellite offices.
Okay, that's
so
interesting.
there are some big changes coming, but yeah, but the biggest surprise for me was most workers that went working from home during COVID lockdown loved it the first 2 or 3 months. And then there was just this weird level of isolation where people actually want to go back into the office now. So I don't think we'll ever lose going back into the offices in a cubicle. I actually think they're going to have much more user interfaces in the offices and networking and idea collaboration and things like that. It's not going to be so much turn up just to do your work. You're not going to turn up if it's just going there to sit in a cubicle doing your work. You'll sit at home that day. So it's going to be very collaborative kind of days and locations. And so there are some changes coming, but office space for the next 5 years is going to have some high vacancies if you're an investor.
So do you think some of the big owners of these properties, these commercial properties and CBDs, do you think they're going to try and transition to upmarket resi or something?
Yes, generally. So there's actually a lot of overseas investors. So 70% of the purchases in the last 12 months for commercial in Sydney and Melbourne were by overseas investors, and 50% of those were Chinese investors. So they must have a bit of a different cultural view on us and think that's going to come back. And it might be internationally, we might be the hub of the world because we've got lifestyle. So we've got beautiful beaches. So that there might be a shift there. If you don't have to be in the office anymore, you're going to start choosing a lifestyle location. But again, I don't know where they're putting their money, but for me, just diversification is everything.
Absolutely. And that's the same with shares, diversify. Another secular trend, I don't know, because you're investing for the longer term, do you do any potential climate change risk assessments on properties you buy for clients?
Generally not, unless you're buying like a beachfront or something like that. But it's not so much the climate change, it's the risk of buying, say, beachfront. So like if you're buying, say you're buying an apartment, which I generally don't like that much of structurally you can have quite large problems as well, because the Rio bars and basically corrodes out, so it rusts out. And then you can be hit with big special levies and things like that as part of your body corporate. You can look at obviously like sea level changes and things like that. But again, you're not, unless you're buying right on the shoreline, it doesn't affect most. You can do all those long-term mappings and things like that for floodplains and things like that, but that's part of due diligence. You look at bushfire risk, you look at flood zones, you look at temperature changes, you look at lifestyle. So you always look at the overlays and the future plannings and things like that. But for me, I actually keep my investing really simple. I just tick all the usual fundamental boxes and make sure long-term I'm going to be okay. Do you find that with shares? Is there kind of forecasting?
Oh, I think,
for like resource sector and mining and things like that, that's obviously needs shifts.
Well, I think it's something that I've been on the case for probably far too long, and obviously we've got a political narrative in Australia that's made it very, very politicized and very difficult. But I think that investors need to be really careful about buying into coal companies and fossil fuel companies. I mean, it's interesting because in this pickup in economic activity, like we're having one of the most strongest rebounds in economic growth in the US, GDP growth of 6%, over 6%. But interestingly enough, even with all the other problems, the oil price is still only $68 a barrel. And if we go back to the GFC, it was $120 a barrel. So I kind of see that it's happening, but like all cycles, it tends to happen rather slowly. It just doesn't happen overnight. But there is a phenomenon where fund managers, particularly pension funds, superannuation funds, where they've got very long dated periods that they have to invest for. So they have to secure that their policy holders, etc., are going to get a certain amount of money back in 20, 30, 40 years. They are very much adjusting their risk profiles to ensure that they're not going to be left with a whole lot of assets that have a zero value if we're going into, let's say, a carbon constrained world. And there's also increasingly a push in the finance sector to invest along a criteria known as ESG, environmental social governance. So it's once upon a time investing in shares. It predominantly started with Milton Friedman in the early 70s. He was a proponent that everything a company operated for, it was for the shareholder. It was the shareholders had absolute supremacy. So it didn't matter if a company dumped chemicals into the water, if they polluted, if they caused lead leakages and, the classic Erin Brockovich type of situation. Now companies just can't do that. There is very much a push that the negative externalities, as you call them, the impacts of them operating their businesses, that they need to be accounted for. Ultimately, that would be represented in a carbon constrained world with a carbon price. But as we all know, politically, even though there are carbon prices and carbon trading mechanisms, I think the carbon price in Australia is really low. It's like $15 a tonne. But that's kind of where the model may well move to over time. And you're also seeing the European Union discussing cross-border tariffs for countries that continue to pollute and produce too much emissions. So I think the investing landscape in terms of shares is changing quite dramatically. But you have these longer term changes going on, and in the interim you've kind of got economic cycles. So at the moment we've got a huge expansion in economic activity, and investors are very much positioning themselves for those type of shares that are beneficiaries of that cyclical upturn in activity. So very much commodity, resource based, steel companies, banks, because there's an expectation that interest rates at the long end are going up, so that's beneficial to the banks. And there's been this huge move out of those growth companies, which were the ones that I touched on briefly before, which have zero earnings but high revenue growth, and they're investing heavily for the future. But those are much more longer dated companies, assets, like you're expecting the earnings momentum to come 5 years down the track. That works in a low interest rate environment because the cost of capital is much lower, so the cost of borrowing for them is lower. The discount rates that you use to get, the valuations of the companies in the present, obviously it's beneficial the lower the rates are. But as soon as there's an expectation that interest rates are going up, investors switch out of those more expensive, high capital gain, high growth companies, but no earnings, and want to go very much into the cyclical companies. Because if you look at something like a BHP or a Rio, they're just benefiting from the doubling in the iron ore price. It's not like they suddenly have to invest that much more to produce that much more iron ore. So the higher the price for them, the more it just basically drops in the profit and loss straight down to the bottom line, which is to the benefit of shareholders. So I mean, like property, I think sometimes I feel some people think property is simple, but it's not simple. It's kind of in many ways like shares. You have to risk adjust it. You have to do it within your own parameters, and you have to look at every property separately just to make sure it ticks all the boxes, as you say.
It is, but I'd actually argue for shares though, you need to be much more multidimensional, because you need to
Yeah,
look at everything you just said. You need to be aware of where a mum and dad client, this is going to sound bad, but a mum and dad client who own one or two investment properties and that's it for their investing, that they don't have to worry about all that stuff. They've bought their asset. Once they've got it, it's just
yeah,
sit there and see how it plays out. And for me, like, that is low risk. If you're buying an area and it's got population growth and you're buying a house with a good land component, you know generally it's going to be okay long term. We can talk about the price going up and down and affording the mortgage and things like that, but long term it's still going to be sitting there. They don't have to be. It's not as time intensive. It's
yeah.
once you bought it, you go on with your life and you just do your job and things like. Some of my friends, they're there every day on their computer looking at shares and having to play. And I actually asked them, "Are you selling?" They're like, "Oh no, I'm not selling today." And I'm like, "Why are you looking? Like, what's it? What's amazing? Oh, I just want to see what it's doing." Whereas property, you don't do that. You might have a chat at the barbecue about how you made a bit of equity, but that's generally it.
Maybe your friends need to take a leaf out of the Shareplicity book, which is basically you don't sit there every day and look at your shares. You know, you kind of
Yeah.
buy a company that'll deliver you long-term earnings growth and return. It's just that they don't do it in a straight line, but then property doesn't do it either. And that's the problem. People don't understand that trying to trade shares is a mug's game. Like it really, really is. It's incredibly hard. And you're right, there are more intricacies, and I think it is a lot harder for people to get their minds around. And unlike a property, every company is an ecosystem, because it's a whole group of people that hopefully have a great CEO and a great leaders at the top who can grow the business sustainably. And obviously, this whole concept then becomes a corporate culture and what makes a good company. And, you know, of course, there's so much more that goes into that. It's not just a case of every company is the same, because you and I both know, when
Yeah.
you've worked for a few firms, is that every company I've worked for, I had great firms I worked for and I stayed with them for a very long time. And then I had other companies where I'm like, oh, this so doesn't work for me. And that's the thing with shares. It's at one level, it's a financial analysis of how much a company makes, because stock markets are looking into the future. They're always looking for the future earnings growth. So you have to understand the financials, both the profit and loss, the earnings of the company, but also the balance sheet strength of the company. So it's cash flows and things like that. But it's not only that, it's also what quality products or services they produce. Are their management able to be dynamic, to grow for the future? Can they disrupt themselves? Have they created a product like, Apple, like we're sitting here on our Macs with our iPhones floating around? I mean, who would have thunk it, 13 years ago that we'd all be Appled up to the nine? But we are, and they're not even the best products on the market. So you're right, shares are got a lot more moving levers, but I guess it's about an asset class that suits different people in terms of where they are in their lives, what they're looking for. And if they've got enough money, you'll probably find they might even have shares and maybe an investment property or two.
Yep. And I actually recommend that to people. I get a lot of people that come to me and say, "Oh, Steve," they might have 3 or 4 properties already, and they're like, "Oh, I want to buy a property in my self-managed super fund." And I'm actually like, "Why? Why not diversify? What have something else?" And it's just they get in the mindset, they make money from one asset class, and they think, "I'm just going to keep doing that." And I'm to blame as well. I started in property. I got very lucky and bought in Sydney in 2012, and that property just kept skyrocketing. And I was, "Oh, this is easy," and I just kept buying. But then I've also bought a couple of properties that didn't perform that well, and I kind of realized, okay, it's not so easy. Your asset selection and timing. The timing is not so much a month or two. We're talking 3 to 5 years is the kind of thing, because that's the thing with property. You could buy something now, and in 7 years' time, it'd be worth twice as much. Or you could buy in a different city, for instance, and buy it now, and it could be the same price in 7 years' time. So market timing's got a huge play as well, and it's much longer lead terms.
Yeah, well, shares are the same. So maybe if we just kind of, because we've covered a lot of topics. So last but not least, so what's kind of the biggest risk or risks do you see at this point in for investors in property? Obviously, it'll depend on which property, but just if you had to generalize.
Okay, so we'll stick with residential because it's a bit simpler. Biggest risk with property, obviously the price changing. So like some markets, well, pretty much every market now is really, really hot. If you go out and buy, say, a $2 million residential property now, it might not be worth $2 million in the next year or two. There could actually be a bit of a rubber band effect where it actually comes back from the FOMO and it drops to 1.6%, $1.6 million. So you haven't lost 400,000, but if you ever need to sell that property, you will effectively have lost 400,000. And that's a point to note as well. Property people always talk about the money they've made or lost, but you haven't made anything until you actually sell the property. So I remember 3 years ago, I had a lot of people going, "Oh, my property's dropped 5%." And I'm like, well, it hasn't dropped 5%. You bought 8 years ago and it's now grown. It's grown 60%. So it's only 55%. And you've still made money, but it still felt like a loss, even though it's not actually a loss. And now those same people 3 years later are talking about how they've made 30% more. So you only realize it if you're leveraging it and you're pulling out the money that you've made, or you sell. So for me, like I said, long-term mindset. Other risks with property are big influxes of cash that you need to put into the property. So what I mean by that is if the property goes vacant, you need to handle the vacancy for a year or, well, not depends on what you're buying, but on average, you'll have to handle about 2 to 4 weeks a year. So that doesn't sound like much, but if it's $1,000 a week rent, that's $4,000 effectively you need to make up. And then the other big one is obviously maintenance. With shares, you're not going to, well, you can correct me, but I don't think the share people ever come to you and say, "Oh, the roof's got some structural damage. It's going to cost you $20,000. Please pay up right now." No. So that's a huge risk because you actually have a physical asset. Some properties, if you go buy a really bad property, you didn't do your due diligence with inspections, you could have bought one with structural cracking or settlement issues. You can be talking $50,000, $100,000, or even worst case, knockdown rebuild, $300,000, $400,000 kind of problems. So you've got to be mindful of that. You're leveraging. So you've got the risk there from price changes. You've got the vacancy when the property leaves and the property sits there vacant. If you buy in a bad area, like a lot of people go out and buy new estates and there's an oversupply, those properties sit there vacant for 6, 12 months kind of thing. So you can burn yourself there. You can burn yourself with maintenance as well. So they're the three big ones for me. So vacancy, maintenance, and price changes because you're leveraging. So what about for you guys for shares?
Well, it's kind of funnily enough, I can actually draw analogies with all of them. So timing is everything too, a little bit in shares. And that's why we say that if you average in, so you get an average price over a period of time, because share markets go up and down, they're volatile. So often it's better to, maybe not throw all your money straight away into the share market unless you're buying like in March 2020 when we had one of the steepest and most fast pullbacks in the market that we've seen for many, many years. So it's an averaging in, because if you do buy at the wrong price, like if you had bought BHP back in 2008 at $50, you had to wait 13 years until it comes back to $50. Now, obviously, you've had some dividend income along the way, but your capital price has only just returned to where it was. And I think you'll find that some of the bank shares are still not back to the prices that they were pre-GFC. So diversification is really important. Like you can spread the number of shares that you have. You can spread across different sectors. You can spread across different geographic locations. But also, when you look at shares, you say, no, they don't have maintenance. But if you buy into a company that is investing heavily for the future or has a bad balance sheet, you can get what's called capital raisings, where the company comes to the market and wants to raise equity. So you may find that you have to keep on tipping more money into your shareholding if you want to hang in there for the longer term. So that's one point. And obviously
that wouldn't be the same in terms of scale though.
No. It's like, not. It's no. But I'm just trying to draw. It's obviously it's not at all. I'm just talking. If you had to draw a wee similarity in terms of, you buy a share and you
Yeah.
don't expect you're going to have to put one money into that particular share. Like a lot of people that have bought,
Okay.
yeah, that's all I'm saying. Oh, scale is completely different. Mind you, if you owned enough of a company, you might have to do that. But yeah, of course, property is.
Good point.
Yeah, again, it's hard to talk generalities, but the other thing is if you've bought a share in terms of income stream that you're expecting to have going forward, and you're a retiree or something, and they cut the dividend, then obviously it's very, very challenging for you, because you've expected to receive this income going forward, and suddenly it halves. And I think investors sometimes forget that shares are not annuities. It's not like, popping your money in the bank and getting, a deposit income. Well, you don't at the moment, and that's half of the problem. And that's why everybody is buying shares. But it's not like an annuity, or if you buy a corporate bond where you get a constant income stream. So I think people get a little bit lulled into a false sense of security that if they buy a share, it's going to produce that income in perpetuity. It's not the way it works. And the biggest problem at the moment for shareholders is probably this huge volatility of share prices going up, going down. And that is because there's this big tussle going on in terms of the experts and what the hedge funds and what the big fund managers are doing in terms of how they're positioning their portfolios. Are they positioning for cyclical reflation of global economies and super cycles? Keep hearing this term, super cycles in resources and commodities and all of that. Or is this a temporary glitch and we'll go back to the secular growth story? So really some of the easiest things that some people recommend, given that there is all these complexities, is that you just buy an ETF product. So you just say, it's a bit like buying a real estate investment trust, and you're buying a basket of properties. You buy a basket of shares and you drip money into that over a period of time. And if you expect the stock market to go off on average, 7%, maybe 8% total return in a low interest rate world, well, that's not such a bad way to go.
Yep, that's actually a point to make. So shares, you actually get to drip feed money into it, whereas property is much more like dominant. You'll save for 3, 4, 5 years, however long it takes you. You'll buy a property, and then you won't be able to do anything until you either one, save in the deposit or get the growth, whereas flat assets.
Absolutely. Anyway, Steve, I think that was such a great chat. So hopefully when this comes out, people will find it interesting. And tell me, where can, if people are interested in buying your book, where can they find it?
Yep. So just go to my website, www.paliseproperty.com, or add me on LinkedIn or something like that, and we can have a chat about property.
Fantastic.
So what about your book?
Shareplicity,
you can obviously go to...
Huh?
Same thing.
Yeah, it's.
I was going to say we can obviously go to any good bookstore, Dymocks, Booktopia, any of those. You can buy our books as well. I've seen.
Absolutely. I think our publisher's done a great job. Our books are available Amazon, Booktopia, on my website, and obviously I've got the second book coming out, which is super exciting, and it takes a deep dive into the US stock markets and what's available, how to buy them from Australia, and that's coming out at the end of June, beginning of July. But I do find that a lot of people, particularly when they're starting out, really want to learn more about property versus shares. So hopefully they will have found this YouTube interesting. First point is, this is not
two books you can buy.
Sorry, Steve, I was
going to say there's 2 books they can buy to get. I was going to say there's 2 books they can buy to research up.
Absolutely, definitely. And we do recommend you do your research, very important. And always remember, if it sounds too good to be true, then it probably is. And that applies for every asset class. And the other thing, and this is not financial advice, everybody needs to seek.
All down.
Sorry, Steve.
I was going to say, just double down. If it sounds too good to be true, just double down. Just keep putting money into it. It'll be fine.
I'm not so sure about that one. You don't do that in shares. Anyway, this is not financial
I'm joking.
advice. Not financial advice. Please get your own financial advice. Never stop learning. It's really important. And you should all probably follow Steve on LinkedIn, and then you can see all his great interviews and media. So thanks, everyone. Thanks for joining us. And hopefully I'll see you all again soon.
Awesome. Thanks, guys.
Bye, Steve. Thank you.
See ya. Bye.
Bye.